Hello and welcome to Zulu Trade. This video will introduce you to the basics of Forex trading. In order to start understanding how Forex trading works, we will be explaining to you the most important terms that you will need to know and will be using on a daily basis when trading Forex. But first, let's see what Forex stands for. Forex, or foreign exchange trading, is the activity where you can bet if one currency will get stronger or weaker relative to another currency. For example, right at this moment, with €1, we can buy 1.39 US dollars. This exchange rate can change at any second. It is the banks which are continuously adjusting to the rhythms of supply and demand that are responsible for this exchange fluctuation. So let's make a bet. Let's bet that the euro will become stronger than the US dollar. In this case, we buy a euro-US dollar pair. Remember, when we believe that one currency will rise against another, we buy the strong currency and we sell the weak one. Since in most cases the sale of the currency will be handled by an outside brokerage firm, all we have to do is buy the euro-US dollar pair. Another way to say this is that we will go long on the euro-US dollar pair. So when we go long on the euro-US dollar pair, we bet that the euro will rise against the US dollar. Or if we go long on the US dollar-euro pair, then we believe that the US dollar will become stronger than the euro. If we believe that the euro will become weaker against the dollar, we can also sell the euro against the dollar. Another way of saying this is that we will short the euro-US dollar pair. So when we short the euro-US dollar pair, we are betting that the euro will become weaker than the US dollar. So let's consider a real-life example. Right this second, with €1, I can buy 1.3940 US dollars. If I go long on the euro-US dollar pair, then I bet that the euro will go up against the US dollar. Now, let's watch what happens. 1.3940, 1.3941, 1.3942, 1.3943, 1.3944, up until 1.3947. Great, we were right. Now, with €1, I can buy 1.3947 US dollars. Let's quit betting and take our profit now. To figure out how much we just made, we first need to check how many euros we bet. So let's say for this bet, I risked 10,000 euros. Before I placed my bet 5 minutes ago, 10,000 euros would have bought me 13,940 US dollars. But after my bet was finalized, 10,000 euros bought me 13,947 US dollars. In just 5 minutes, I made a profit of $7 as the euro gained 7 pips against the dollar. What's a pip? Good question. 1 pip represents 1/100th of a percent, or 0.0001, which is the smallest amount of currency fluctuation used by Forex, and it is the unit used to express the price change of an exchange rate. The brokerage firms want to help you make larger bets without you having to deposit the full amount of the bet. To understand how leverage works, let's assume that you believe that the euro will become much stronger against the dollar. You are so sure about this that you would even bet 100,000 euros, but you can't afford it. No problem. The brokerage firms will let you take this risk and lend you the 100,000 euros. All they need from you is only 1,000 euros as a collateral deposit. From the brokerage firms, you can borrow 100, 200, or even 400 times the amount of your initial collateral deposit. If you risk 1,000 euros from your own money, you can place a bet between 1,000 and 400,000 euros. It's up to you. If your cash in pocket is 1,000 euros and your bet is 1,000 euros, then you don't exercise a leverage. Or you can say that you exercise a leverage ratio of 1:1. In case you want to bet 50,000 euros with only 1,000 euros, then you exercise a leverage of 50:1. Now, the big question is, do the brokerage firms lend the money for free? No, they don't. They charge you according to the current interest rates, but we will examine this issue later in a different section. A lot is an industry term used to describe the size of a bet. A 1,000 euro bet is a micro lot. A 10,000 euro bet is what we call a mini lot. A 100,000 euro bet is what we call a standard lot. So, for example, if we go long on a mini lot of euro US dollar, that means we are betting an amount of 10,000 euros. Remember, the actual deposit that we need to make for this mini lot could be from 1 to 400 times smaller, depending on how much money we decide to borrow from our brokerage firm. Why do the exchange rates move so fast? As you probably know, if you have euros parked in your local bank account for 1 year, your bank will credit your account with a certain percentage of interest. However, what you may not know is that interest rates vary among different currencies. For instance, the interest rate on your annual deposit in euros in a bank in Paris might be 3.5%, whereas your friend in Britain might be earning 5.5% interest on his deposit in pounds in London. In order to take advantage of the higher interest rates of the British pound, you would probably sell your euros and buy British pounds. However, you would probably not be the only one. Many individual investors and banks could do the same. And if enough euros are traded for the pounds, the euro will become weaker and the pound stronger as decreased demand for the euro drives its price down. Another reason why exchange rates move so fast may result from multi-billion-dollar companies who need to convert the currency of large amounts of money. For example, let's say Toyota, the car manufacturer, sold 1 million cars to the United States. Toyota has been paid from the US importers 20 billion US dollars, which gets deposited in a US dollar denominated account in Japan. It's April and it's tax season for the Japanese residents. Toyota has to pay 1 trillion Japanese yen in taxes this year. That's close to 10 billion US dollars. This is a large amount, even for Toyota. In order to pay the Japanese government, Toyota will have to convert the 10 billion US dollars to Japanese yen. So, Toyota goes into the Forex market and sells US dollars and buys Japanese yen. The demand for US dollars at this moment will naturally go down since 10 billion US dollars are being sold all at once. Similarly, the demand for Japanese yen goes up because somebody wants to buy 1 trillion Japanese yen. In this case, the exchange rate between the euro and the Japanese yen could easily be affected. A last example relates to the timing and circulation of market information. For instance, let's say a financial report is published and shows instability in Europe. The unemployment rate has been going up lately, and companies are beginning to report negative growth. This news will scare many banks, prompting them to sell the euro, and the euro will decline against other currencies as a result. An important point to remember is this. Typically, the stronger the image of a country or a group of countries that represent a currency, the stronger that currency becomes against others in the long run.